Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world, one filing at a time. Today we're diving into Xenia Hotels and Resorts' latest 10Q report. It's like checking into a hotel, but instead of a comfy bed, we get balance sheets and income statements. It's going to be quite a ride, and by the end we'll know if they're really raking in the dough or just making up the room. So what's the story this quarter? Xenia, a company that invests in luxury hotels and resorts, just released their report for the first 3 months of this year. We're going to look at where they're making money, what challenges they're facing, and most importantly, are they living up to the hype? If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can chat with other corporate decoders. First, let's set the scene. As of the end of April, they had almost 99 million shares of common stock out there. Keep that number in mind as we dive into the money. Now let's hit the numbers. We're going to quickly scroll to the financial highlights, and I promise to keep the accounting jargon to a minimum. Checking out the assets, their net investment in properties is about $2.5 billion. This is basically the value of all their hotels after you take out wear and tear. What accountants call depreciation. Think of it as the real value of their hotel empire. On the other side, looking at liabilities, they're sitting on about $1.4 billion in debt. This is how much they owe after some accounting adjustments such as loan premiums. It's always a dance between assets and debt to see if they can actually pay up. Digging deeper, we see they have negative retained earnings of around $678 million. This distributions in excess of retained earnings is accountants' word for when a company paid out more in dividends than it actually earned. This can be a red flag since, money doesn't come from trees, it has to come from revenue. Let's switch gears and check out how they're actually making money. It's time to break down the profit and loss numbers. Their total revenue for the quarter was roughly $289 million. Most of that revenue came from rooms, which came in at roughly $160 million, with food and beverages adding roughly $105 million. However, running hotels isn't cheap. Total hotel operating expenses ate up about $196 million. Once you subtract those expenses plus depreciation, real estate taxes and other costs, the operating income is around $36 million. Taking a deeper look into the numbers, it's worth noting their interest expense was $21 million. After all the math, they're left with a net income of about $16.5 million. That's how much money they actually made after paying all the bills. That translates to earnings per share for you, shareholders, of $0.15. Not bad, not great, but it could be worse. Now let's move on to how cash is flowing in and out of Xenia. Cash flow is king. If you look at what's actually happening with cash, it makes even more sense. For the 3 months ended, cash flow from operating activities tells that almost $55 million was actually coming in. They did spend almost $25 million to purchase an investment property and more than $32 million on capital expenditures. On the financing side, $36 million was spent to buy back their own shares and pay dividends of almost $12.5 million. This is to reward shareholders by giving them more value. Now, the elephant in the room, debt. The filing talks about different kinds of loans they have, including mortgage loans and corporate credit facilities. We also learned that they were actually in violation of a debt covenant on a loan, then they fixed it later. They use interest rate swaps and other tools to protect themselves from interest rate changes. This is important because if interest rates go up, the cost of borrowing goes up. Revenue sources are also well diversified. Some of their key markets include the Orlando, Florida area, as well as Phoenix and Houston. They also held some assets for sale and liabilities associated with it. The company issues share-based awards, including stock options, restricted stock units, and LTIP units. They granted time-based and performance-based incentives. We also know the executives' compensation information, which is always spicy to see. One important point of these kinds of filling is that the company has leases, including long-term ground leases, where they commit to pay. Lastly, there is a mention of legal battles with the company, claiming nothing material should come of that, but it's worth keeping in mind. To finish out the report, in April, they sold the Fairmont Dallas Hotel for a $100 hotel for a $111. This all means Xenia appears to be in a reasonably stable position, especially for a company in the hospitality sector. They are expanding their revenue streams with some strategic purchases of land, particularly their hotels in Orlando offer the challenges of economic uncertainty and potential conflicts are clearly there. While they are doing a reasonable job of keeping their operation afloat, the underlying financial picture isn't very pretty. Xenia needs to manage its debt very carefully because any small hiccup might require refinancing their debt, which would cost them a lot. Overall, the company's direction is stable, but keep a close eye on rising operating expenses and potential economic slowdown. But so far, the numbers look pretty good. That's our breakdown of Xenia Hotels and Resorts' latest 10Q filing. What's your take on these numbers? Drop your thoughts in the comments, hitting that like button if this analysis was valuable, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.